Back in the 70s, Yale Hirsch from Stock Traders Almanac discovered a really good pattern in the stock market. If you buy the stock index one day before Christmas and sell it 2 days after the New Year's, then you will make really good money. Now, you really need to pay attention to this pattern because even if you don't trade it, it will affect all your strategies that you are trading in your portfolio. Now, year-end taxes and mutual fund window dressing at the end of the year affect this pattern a lot. And although those two variables have changed a lot since the 70s, but still the pattern persists and makes really good money. Also, this pattern falls in the bigger pattern, which is sell in May and go away, which I talked about on the channel through this video. Currently, this pattern is called Santa Claus Rally or year-end rally, and it drips into January effect. And all these patterns fall inside the sell in May and go away. Of course, being an algo trader myself and some viewers watching this channel, so we need to test this pattern and make sure that the numbers are correct. So first of all, let me show you the tendency of the stock market to go up. I'm using Season X with 71 years of data. And if you buy on January 1st and sell on December 31st, for the past 71 years, on average, you make 7.59%. The winning trades are 72.86%. If you bought January 2008, sold end of the year, you lost 48%. So this is the first thing you need to pay attention to, that the stock market index globally, but especially in the US, tends to go up. Why? Because the index itself, it's a system. It's a system that brings in good stocks and get rid of bad stocks. Although it's like a very rudimentary system with a huge drawdown, still it is a system, and that's why it has this tendency to go up. So at least it's a good system to start with. So this is the system starting on the 24th of December and selling on January 4th. And you can see we are holding for 7 trading days, although calendar days they are 10, but on average there are 7 trading days. And we can see that we have 42% annualized return. What does that mean? That means if you extrapolate this winning percentage over the whole year, then it will become 42%. So what Yale Hirsch discovered in the 70s still works till today. So why this pattern is important, even if you don't want to trade it? Because if you're trading any stocks, then you need to pay attention to this pattern, because this pattern will decide that in those 10 days and in this 7 trading days, you need to pay attention to go long only. Of course, most likely you're going long only, but this increases the probability that you will make money in those trades. Also, since the S&P 500 is cap weighted index, that means, for example, Apple makes a huge chunk, a percentage chunk of the S&P 500. So it makes sense then to go, let's say, the top 10 stocks in the S&P 500 in terms of weight. You can go long those stocks only in this period. Or if you have strategy trading, let's say Apple, then you should double your position size in this period. So as you can see, there are many ways to use this pattern, not only trading the pattern itself. Of course, if you want to trade the pattern, then you can buy the SPY, which is the ETF trading the index. There are literally probably 10, 15 mutual funds that replicate the S&P 500. And of course, you have the futures, the micro futures and the mini futures and the full S&P 500 futures. So there are many ways to get action into this pattern. So we know the pattern exists, and now let's try to enhance this pattern. Remember, this pattern drips into January effect and is part of a bigger pattern, which is to buy in October and sell in end of April. So first of all, from Season X, we can see easily that this is a better pattern. So if we go long December 15th and sell January 7th, we have 78% winning percentage, averaging at 1.8% per trade. And we can see here we have 7.65% down. Here we have 5.49. So 4% stop loss will keep you in all the trades except 2. Or you can put 8% stop loss and you will be in all trades. Now this pattern is holding for 15 trading days, so that's double Hirsch pattern. But of course, we have a better winning percentage and we're making more money. Now you can take this pattern into your trading platform of choice. Here I have TradeStation, and I loaded the cash index, which is the SPX, because the SPX goes back to 1960. So I have more data to test, and this is the same strategy here is buying on the 23rd and selling on the 4th. So if we put the strategy on and we pull the performance, so we have 61 years of data and trades. We're averaging $5.51. Remember, this is the cash index, so this is the number of points. This translates to number of points. So that means on average we're making 5.51 points, and in total we make 335 points. So to translate this into dollars, if you're trading the E-mini futures, so 5.5 times 50, that's $275 per trade on average. Now, if I optimize the starting date, so we can put 10 to 29, and I'll optimize the exit date from the 1st till the 20th of January. Let's see what we get. So this is the performance report, and if I sort by the highest net profit, and let's look at the top 10. So in the start date, we have 14, 15, 14, 15, 14, 13, 14. So, and even look, 11, 12, 13, 14. I mean, definitely it is 14 or 15. That's the starting date, which is what we have here. We have 15, we can go back one day. So the 14 is definitely a better way to start. If we fix this at 14, since we cannot do 3D charts here, I need to fix one to see the graph. Let's go further to 25th. And we can see that this is the exit, January 1st till January 25th, all of them starting at December 14th. And we can see all of them are profitable because, like I mentioned, the Santa Claus Rally or year-end rally spills over into the January effect, which is, again, January makes a lot of money. And 18 is the peak, but all of them makes money. And we can see also 8 is another peak, but again, I mean, the difference is minimal between the 7th and the 15th. But it's definitely not worth holding till the 25th, because now you're adding more days, more holding days, which is of course more exposure in the market, and you're not making extra money. So let's try the 7th and the 17th. So this is the 14th till the 17th. So now we're making for almost 15 points, and again in futures, in E-mini futures, that's times 50, so 15 times 50. So now the average trade is 750. And if we exit on the 7th, which is saving 10 days of exposure, we go down to 13 points, and that translates to 650. So $100 less in average trade. But again, you are 10 days out of the market faster than the other pattern. It's 77 winning percent. So in total, if you're trading the E-mini futures, that's $40,000 per contract, holding only 16 trading days. And this is the pattern in Season X, so 14th till the 7th, 77% winning percent, and that annualized to 30.28%. And you can see if I remove the 50s decade, which the data I don't have in TradeStation, we match TradeStation performance, so 799.41, and here I'm making 799.37 points. Still 77% winning trade, of course, which matches this one also. So a great pattern to pay attention to. You need to put this in your portfolio, and there are many patterns during the year that you need to add to your portfolio, or at least use it as a filter for your index trading or stock trading. Of course, if you have any questions, any comments, please do so below the video and I'll be more than happy to answer you. I do read and respond to all comments sent to the channel. And if you want to take this further and be a part of my inner circle, you are more than welcome to join the Discord server, where I host many live sessions to answer your questions. I already have more than 400 questions answered in these video sessions, alongside the tactical asset allocation portfolio signal, the stocks seasonal portfolio signals, and much more. If you made it till here, you are awesome. Merry Christmas, happy holidays. I wish you the best in 2022. And as always, good luck with your trading, good luck with your investing. Stay safe, and I'll see you soon.